My name is Stacy Worden, and I run the Center for Financial Markets at the Milken Institute. And my founder, Mike Milken, the chairman of the Milken Institute, actually created an entire market, fundamentally, basically, on his own. So in the 1970s, you could, if you were a US corporate, you could have an IPO, which is of course very expensive, or if you were an investment grade company, you could issue debt. But if you were not an investment grade company, you were basically relegated to just taking out bank loans. And now, this is, then it was called the junk bond market that he invented, and now it's got a very respectably named high yield market. And so we are, access to capital and the strengthening and deepening and broadening of capital markets is fundamental to our DNA at the Milken Institute. And before I kind of go forward, I want to introduce you to my colleague, Mindy Silverstein, who is who's really led our efforts to engage our work in Africa and to make sure that, Africa is really at the top of the agenda of the Milken Institute. So Mindy, can you just quickly stand up? And anybody that would like to meet her later, now know what she looks like. Okay, of course, I want to thank the President and the Minister of Finance, Minister Gatete, and the Governor of the Central Bank, Governor Rwanda, and my colleagues at the Capital Markets Authority, my fellow board members, and of course the executive leadership, and of course, Jingdong Hua. Let me also, though, give a shout out to the dark side bankers that are here, because I see folks that I've known for a long time here, right? From Barclays, from PNB Paribas, of course from Standard Chartered, and there's many others here. And these guys, they spend a lot of their lives on airplanes running around this continent trying to develop the private sector and trying to get finance to the corporate sector of these countries. So I would suggest to you that that is not the right way to describe what they're trying to do on the continent. Okay, so listen, research shows that there's a very positive relationship between the financial sector development and growth and poverty reduction. And that's for a very simple reason, and that's that there are more opportunities to channel savings in more different ways to investments. And it's the kind of thing that Governor Ndulu said this morning, right? That you have to, and Jingdong tells me this every single time I see him, that growth comes from this virtuous circle of savings, financing companies, leading to growth, generating more savings, and that can only really happen with a vibrant capital market. Now, this is the last time that I ever do one of these things where I have to speak last, because all of the good ideas have actually already been, mentioned in one form or another already today. But let me just touch on a couple of things that I think are really important, just in terms of the important components of a capital market, how you need to get there. I'll touch a little bit on sequencing, and then I'll end with a little bit about regional economic integration. So first, as the governor mentioned in the last panel, macroeconomic stability is fundamental. Deep liquid capital markets lessen, macroeconomics, because deep and liquid capital markets lessen the economy's exposure to external shocks. And the governor spoke at length about that in the last panel. Secondly, during downturns, banks shrink their balance sheet, right? They de-lever, and then corporates turn to bond markets. So in the Great Recession, the financial crisis in the US, loans to American firms dropped from $4.5 trillion in 2007 to $3 trillion in 2012. But bond issuance during that period tripled. And you saw similar trends in Europe and China. And this is why capital markets are often referred to as a spare tire for the financial markets. Third, capital markets are very important for financial stability. And in fact, some research was just done looking at 150 years of observations. And bond market crises that come about when companies default on their bonds have far greater impact, negative impact, than bank-led crises when companies default on their loans. And why is this? Because in bond markets, individuals hold those instruments, and so individuals lose money. But in banking markets, banks lose money, and the institution gets hurt, and they're fundamental to the financial market. And then last, and I haven't heard this really talked about in depth today, but capital markets are also fundamentally important to the central bank's ability to conduct monetary policy. right? So when Chairman Bernanke wanted to support US mortgage markets and corporate borrowing, what did he do? He embarked on quantitative easing. And what did that mean? He bought up short-dated paper, he forced investors out the credit curve and out the maturity curve, brought those yields down, and then got those markets going in that way. Now, the governor of the European Central Bank, Mario Draghi, is undertaking the same, about to contemplate the same quantitative easing, but they don't have the same kind of mechanisms in Europe. So how is that going to actually play itself out? It's a very big question, and you're going to see that much more in things like a depreciating exchange rate than you will through these bond markets. So in 1970, in the United States, bond markets were 11% of GDP. 11%. Now they are at 70%. You might say, okay, well, the United States is not a good example for Africa because it's just simply too developed and too far ahead. But there are countries that I think are very much aspirational for Africa. Malaysia has been mentioned in the past, the Philippines, Thailand. You know, market cap of equities in the Philippines and Thailand, for example, were about a third of GDP in 2000. Now they're 100% of GDP. Bond markets in Southeast Asia, local currency issues were $165 billion in 2000. Now they're at about $1 trillion in 2013. Same thing in Latin America. Equity markets have grown 4 times in the past decade, from about $560 billion to $2.4 trillion. And local currency bond markets have gone from less than $30 billion in 2001 to $2.8 trillion in 2013, a 100-fold increase. And during this time, we had a global financial crisis, let me remind you, right? So capital markets development is very much part and parcel of the growth story of these countries. And this is the kind of, these are the kinds of growth numbers that I think Africa can and should aspire to over the course of the next decade. It's absolutely possible for Africa. So what are the preconditions? And we have heard a long laundry list of preconditions today. But let me just note a couple of things that I've heard that I want to kind of touch on. First of all, you know, macroeconomic stability is paramount. We've heard that a number of times, right? Because the expected profitability of long-term projects are going to depend on long-term low interest rates and and they're going to be kind of negatively impacted by any kind of macroeconomic volatility. Secondly, you need a strong and clear, but also flexible and kind of efficient regulatory environment. One of the ironies I find when I work with countries is that in many countries, the regulatory environment is at the same time too overbearing and also too vague, right? And you can see a really interesting example of this in India, actually. So the stock market, the regulatory authority of the stock market was very adaptable and efficient, and you can see the growth of the stock market in India. And the Reserve Bank of India that regulates the bond market has been, until very recently, quite a rigid regulator, actually. And you've seen very little bond market development in India. Now, in the last panel, we talked about a little bit this kind of competition between the banking sector and the capital markets, and how does that work? And I want to just say a couple of things about that from my point of view. You know, over the decades, governments and aid agencies and consultants, we have all very much focused on having a strong banking sector as really a cornerstone of financial market development. And that is absolutely true, and we're right to prioritize that. But it can become a bit overwhelming to the development of capital markets. You know, in the beginning, a relationship between a creditor and a borrower is really the only way to do a credit assessment when there's a very low information environment. Right? And furthermore, you know, I would say, of course, banks play a very important role in capital markets, that money markets are, of course, the cornerstone of capital markets. However, and I'm not going to name any names here, okay, but there are some countries where the banks are the dominant source of income and governments are the dominant users of income. So you can get a very stable banking sector that all it does is buy treasuries from the government and doesn't play any kind of financial intermediation role in the economy. Now, like I say, I'm not going to name names, but getting beyond that is going to be clear, fundamental to financing the private sector. And Chitra said, in a very polite way, that sometimes governments need to give a policy nudge to kind of level the playing field. And, you know, I will say it a bit more starkly. I think that sometimes government policies, such as, you know, excessively subsidized deposit insurance, for example, double taxation of dividends, very much to the detriment of capital market development, favor the banking sector. And you know, capital markets are essential to a healthy banking system, right? On both the asset side and the liability side, and as an important source of market information for banks. So in terms of sequencing, I don't have a view on exactly how capital market sequencing should work, but I do know, or I do believe, that what is most fundamentally important is the development of local government bond markets, because the private sector needs that benchmark in order to price itself going out, and it's critical for spread compression for all kinds of bank issuers then and corporate issuers. Unfortunately, in many countries, though, government bond issuance is sort of need-based, and so that means that there's a lack of stock, and the market doesn't know when the central bank is coming to market. And the priority often in many countries is to give priority to lowering funding costs. So, issuing short-dated instruments rather than, taking steps where maybe funding cost is a little higher, but actually taking steps to methodically lengthen the yield, to lengthen the yield curve. And I'd like to commend, of course, the Rwandans, who have now started a regular issuance program, and that's going to be fundamental for their the development of their capital markets. So secondly, though, governments need to create a kind of an enabling environment for increasing secondary market trading. And there, I think it's going to be important to develop some kind of a primary dealer scheme where there's market making for the secondary market. It's going to be important to establish sort of efficient price dissemination systems. It's going to be important, again, to make sure that there's a level playing field for all participants. And I won't say anything really about developing equity markets because that's been covered in depth today, and we're going to talk about it in the plenary panel tomorrow. But I do want to say a couple of things about corporate bond markets, because I think there's really a fundamental irony at work here that, when we call the capital stack, right? The riskiest part of the capital stack is the equity market, or equities. And that's where you see the most market development across the world. And the most less risky bonds are much less developed. And I find that kind of ironic, actually. But of course, there's a reason for that, and that bonds have some problems that equities don't have. So they're heterogeneous. Different companies issue different bonds, and they're not kind of you can't trade one for the other. They're also non-fungible. So a new issuance can't be treated exactly the same as an issuance that's already out in the market, and they tend to be buy and hold, which is of course a vicious circle, because if there's no secondary market liquidity, then people have to buy and hold. So just a couple of anecdotes I think that we should consider talking about in more depth tomorrow would be to broaden the range perhaps of offering mechanisms for corporate bonds, so fast track options, shelf registration, that kind of thing, developing that. And then I think we should also talk about and consider hybrid options, right, where if you target qualified investors, then you can have a short form prospectus or have a little bit easier regulatory approval. And 70% of the high yield issues in the United States are actually come to market in this way. So. But in general, I want to just talk about, I guess, three things that I think governments should keep in mind in a general sense for capital market development. First, and this gets back to sequencing, is demand-driven capital market development. Like, talk to the market and find out what it wants, especially issuers. And we've talked in the last panel about people don't actually want to, want to list their shares on an exchange. And, when I think about it, if I was running a large and growing exporting firm, and I was kind of thinking about what capital markets I would want, well, I'd probably want to I'd want sort of shadow banking type stuff. For sure, I'd want to be able to securitize my receivables. I'd want a factoring market. I'd want to be able to hedge my FX exposure. I would definitely want derivatives market, right? But derivatives kind of have a bad name, but I would want derivatives in order to manage my risk. I'd want derivatives to lower the cost of buying bonds using forward markets. So I think we can never do too much of sort of ongoing discussion with the private sector about how to sequence things. Secondly, I would say develop the buy side. And this is an observation that is true not just in Africa, but also in the United States and elsewhere. And look, I get it that pension funds have a fiduciary duty to an economically dependent segment of the population. And so, of course, they're going to be naturally very conservative. But it is also true that pension funds have a duty to generate long-term real rates of return in order to meet their liability obligations. And it is not at all clear to me that investing in short-term government paper is the right way to go about doing this, right? And especially when the liability side of pension funds does not require really a liquid portfolio. you know? So you've got trillions of dollars of cash sitting on the sidelines and trillions of dollars of infrastructure needs. And somehow it seems to me that they ought to be able to find a way to finance each other, for one to finance the other. And third, this is what I call my use it or lose it motto. Governments, if they want to develop capital markets, beyond being a regulator and beyond the other roles that they play as the government, they are also a very important economic participant in the economy and in capital markets. And so if they want to develop capital markets, they have to use capital markets. Fundamentally, this means privatization, fully or partially listing shares in state-owned entities on the domestic stock market. If you want to, and the private sector is waiting. Of course, they know, right? They're just waiting to see what the government's going to do. If the stock market's not good enough for the government, why would I list my own shares on the stock market, right? Secondly, if you want to develop secondary markets in government bonds and government paper, don't allow every entity in the economy to have access to the primary window, right? That doesn't make any sense. So you've got to develop some kind of a primary dealer market, in my opinion, in order to get that secondary market liquidity going. Third, don't make private investments. So if you want to make a private, as a government, you fund, say, some kind of project. If you want to get a project bond market going, well, then have that entity issue a project bond and then buy that project bond, right? So use capital and force to use capital markets wherever you can, and that will help, sort of underpin them and get them going. So let me just give a couple of shout outs to Rwanda for a couple of things that I think they've done very well. And of course, I've been the chair of the Rwandan Capital Market Authority for about 4 months now, so I'm personally going to take credit for all of this, as you can imagine. They've got a very conducive legal framework, right? So they've been quite dynamic in responding to the market needs and assessing priorities that way. And so I think that's been quite important and well recognized. Second, they have a very open and flexible market environment. So beyond the legal framework, which is also quite good, they've got and they're kind of famous for this, a very fast approval process for licensing and the like, both for new licenses and for new issues applications. Thirdly, they've established a central depository for the country. So. Typically these are split out between equities and money market, but they've had from the very beginning just one depository, and what goes with that is the paperless settlement of securities. So people in Rwanda, you've never seen a physical share certificate in Rwanda, and they've also championed regional integration in a really important way. They were kind of last to the party, but since they've come to the party, they've been the first movers, right? So they were the first country to fully implement the Common Market Protocol. And they've now have a joint initiative with Kenya with a CDSC in order to mitigate a bit some of the illiquidity on cross-listed securities by establishing an interdepository mechanism. But here's the bad news, I would say, that Rwanda can do everything right. It could absolutely do everything right, and still, I would argue, it is not going to have a deep, liquid, vibrant capital market. The economic size is simply not there for this country, nor is it there for Uganda, nor is it there for Tanzania, nor would I argue is it really there for Kenya. I believe that capital markets really need to have an EAC integration in order to get deep capital markets in this region. Because if you think about it in those terms, then you're thinking about an economy with 135 million people and a $125 billion economy. Now, a $125 billion economy is that's enough to make you stand up and take notice from wherever you are in the world. That kind of size enables the kinds of standardization that we talked about in the last panel that allows the deeper liquidity and deeper markets. And so, what would this capital market integration look like? Well, first, capital would move freely across markets. Issuers would be able to raise money across the EAC. Investors would be able to invest across the EAC. Intermediaries would be able to provide services based on their own home country approval. And so what does that mean? Well, for companies, for issuers, this kind of harmonization very much reduces the administrative burden for them. There'd be one set of disclosure documents, maybe with a wraparound for multi-jurisdiction. And as Ted Chu said in the last session, companies would have a lot more choices about financing options. And this is all about, I think capital market development in general is all about reducing the burden of information acquisition, right? So if you have more, if you can lower those costs of explaining to investors about your company, then you're going to be able to develop deeper markets. You know, for investors, they get better opportunities, more products, more competition from intermediaries, better diversification. You know, and I'd like to use an example of Chile, just to not pick on Africa. But you know, it's not at all clear to me that the pension funds in Chile should be investing in Chile when the whole country is so already dependent on copper, the price of copper. Copper is now at record lows, and so is that really the right kind of multi-generational macroeconomic management? I would suggest to you that it is not. We've talked, Chitra mentioned, and other people have mentioned the importance of intermediaries, and I second that. A survey by the AFDB that was done a couple of years ago said that the two most important things for capital market development were lack of economic scale and not enough intermediaries. And of course, they go together, right? Because more economic scale means better intermediaries. And then it's also quite good for governments because you get budgetary savings from being able to not duplicate efforts and the like. And last, I would say, you get the ability to market the EAC as an asset class. And I think this is really a phenomenal potential opportunity. So you can get regional equity, bond, and derivative products to foreign investors. You can develop collective investment vehicles at the regional level, indices, ETFs, that kind of thing. You can do a regional coordination of investment promotion efforts, and you can do regional infrastructure projects. Again, you know, this is all much easier with regional capital markets. And so the idea is that with better financial markets, you can attract more FDI. And with more FDI, you can improve your infrastructure. And with better infrastructure, you will improve your trade flows. And with better trade flows, you're going to get more growth. And with more growth, you're going to get richer. And as you get richer, you're going to be able to demand and you're going to require deeper financial markets. And when you have deeper financial markets, you're going to get even more FDI. And I would suggest to you, ladies and gentlemen, that that is the ride that we want to be on. Thank you very much. I'd be happy to take any easy questions, and I will refer difficult questions to Jingdong Hua in the front row. Yeah. No speeches, David.
Yeah, thank you, Stacey. Very stimulating speech. What would be the model for the EAC? Would it be like the Belgium, Luxembourg economic community, which of course was very successful, or would it be Switzerland and Liechtenstein? I mean, Belgium has got a GDP, I think, of about $500 billion, so you're still well way down below Belgium. But could you give us a few sort of role models from the world outside?
So I think the two kinds of models that you can talk about, I guess there's three. There's the European Union, of course, which is a fully integrated, or aspires to be, I would say, a fully integrated capital market. But typically, you compare what we call the Asean model versus the model in West Africa. So the West African model is a fully integrated capital market, right? They all share what used to be the CFA, and now it's tied, very tied to the euro, and all of those countries share that currency. There's one central bank. There's one entity that issues government paper, and the Treasury bill market has, since the consolidation of institutions and regional institutions there, has exploded, I think, 15 times. The ASEAN model is more about passporting and taking, allowing the regulatory, approvals of one country to work in your country, and kind of sharing of regulation and passporting and that kind of thing. And I think it's kind of a false choice to choose between them, because you've got to pass through that ASEAN-type model before you can get to that more fully integrated model for sure. So I think, it's easy does it, but there's a pretty enormous checklist already to get done just to have kind of the first steps of capital market integration in the EAC, and whether it should move forward after that to full one currency and fiscal consolidation. I think let's cross that bridge when we get to it, I would say. Yeah, Jingdong.
Thank you, Stacy. I'll make sure I will always speak ahead of you because I can't speak after you. You're so good. The only point I wanted to emphasize is that we don't want to send chills on the spine of bankers. That is, as the size of the economy grows, there is space for both banks and capital market. That is, one is not the substitute for the other. They're completely complementary. So I know you mean it. So that's it.
No. And let me actually build on that point. I think that to have a vibrant banking system absolutely requires vibrant capital markets. I mean, banks are often the very first users of capital markets, both on both the asset side of the balance sheet and on the liability of the side of the balance sheet. And beyond that, capital markets also give incredible pricing mechanisms, price signals to banks that banks can use for doing their own loans. Now, on the other side, capital markets are absolutely fundamentally dependent on banks. First of all, because banks are kind of the most intrepid users of capital markets, especially in the beginning, and also because money markets are critical to, they're a critical foundation to capital markets. And then I think this middle ground of, shadow banking, which again I think has kind of a bad name associated to it, which is actually fundamental, these securitization markets, derivatives markets. These depend very much on a cooperation between the banking sector and the capital market sector. So I couldn't agree with you more, Jingming. Yeah, absolutely. Okay, and I guess I'll take the last question. Thanks.
Thank you very much. My name is William Masiko from Kenya. One of the things that we haven't talked about today is human capacity and how that can constrain the building of capital markets.
Yeah.
On top of having constraints in the capacity, the size of the markets, many African countries also have low skill levels, particularly in capital market development.
Yeah.
What would your perspective be in terms of the experience you've seen in other places? What should they do in order to ensure that this doesn't hamper the building of capital markets in their territories? Thanks.
Yeah, absolutely. Okay, so I think a couple of things are really interesting there, and it's a great question, and also something. It's a little bit of a softball to me. Thank you very much for being able to talk about what we're trying to do in capital market development. But I was the ambassador to the United States from Singapore. Came to visit me last week actually. And so I was telling him about this conference and what we were trying to do, and I said, so tell me, what did you do in Singapore? And he said, just education, 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 education. That is all we spent money on. We didn't buy, actually, fancy trading systems. We dumped all of that money into education of market participants. And he said, and it's still an ongoing effort. And so I think that very much needs to be prioritized. Secondly, I think it can be hard for regulators to have a regulatory environment that they are not comfortable enforcing, right? So you also want to make sure that your legal and regulatory environment doesn't kind of get ahead of your ability to stay on top of that. And DFID, I don't know if Mark's in the room, but DFID's doing a lot of good work in Kenya actually about strengthening the financial knowledge of market participants. Third, I would say that this is a little bit, a bit more risky of me to say, but the more that you can integrate institutions in the EAC, the better off you're going to be, right? Because if you've got, every country in the EAC has its own stock exchange. Well, okay, maybe that's a good idea, but if you had a regional bourse, with maybe a rotating presidency or something or some such, then you could really invest in talent and regulation, and you'd get the kind of economies of scale that regional integration would allow. And then last, I think I will just, just say that the commitment of the IFC and the commitment of the Milken Institute to really trying to help the governments of these countries and attack these kinds of problems of capacity building is something that's very important to us, and you're very right to say that it's fundamental. Yeah.